I think we will go higher into year end again, and we will print fresh all-time highs into the year. I guess my stronger conviction now is my medium-term view, which is that by the end of 2028, so by the time Trump leaves office, we'll get to 500,000 for Bitcoin.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next.
Ladies and gentlemen, welcome back to the Wealthion Pod. My name is Chris Perkins. I'm president of CoinFund. And today I'm really excited because I have one of the boldest research analysts, folks that make the biggest calls, a guy named Geoff Kendrick. Geoff is global head of digital asset research at Standard Chartered. And what I love about this is that he makes incredibly bold calls, but he does so inside a bank. And so welcome, Geoff.
Thanks, Chris. It's a pleasure.
It's awesome. Look, you recently came out and you said you don't think Bitcoin is going to drop below 100K ever again. As we get into it, I would love to know how you got into the space in the very first place. We'd love to hear a little bit about your background and then want to get into some of your predictions and calls.
Yeah, of course. So I run digital asset research at Standard Chartered, have done for about 5 years now. Before that, I spent the best part of 2 decades as a macro strategist. So I'm an economist by training, not a technology person. I had spent a long time as a macro strat, mostly looking at FX and rates markets, most directly with Standard Chartered in emerging markets before coming over to digital assets. So I actually came at this space originally somewhat skeptical, which is interesting compared to where I've come now, obviously, given my views are quite bullish. But I started out, I guess, with little knowledge 5 or 6 years ago. Obviously, I knew some things about Bitcoin and Ethereum and et cetera, a little bit about blockchain, but I spent most of my time around COVID deep diving, learning the new asset class. And then once I got through the rabbit hole or the looking glass or whatever analogy you like, came out the other side and said, actually, I can see how this is a completely new technological solution, how it's going to disrupt TradFi, et cetera. And since then, I've gone all in, really, and effectively bet my career on this in the last few years.
I really appreciate that. So look, yesterday we had the Fed come out. It feels like the market is not responding incredibly well to it. You got, in the background, Trump doing his thing in China. Can you paint a macro picture for us? And how do you see, things like the Fed, things like U.S.-China relations impacting the price of Bitcoin?
Yeah, so it's been a bit complicated this year. So Bitcoin should be a hedge against issues in the traditional financial system, be they in banks or in what Trump says about Fed independence, for example, right? So whenever Trump talks about the Fed, you would think that would be Bitcoin positive because this is like a risk in TradFi or in treasuries that back up TradFi. That should be Bitcoin positive. So we've seen a bit of that this year. But things like tariff wars, trade wars, so we had a chunk of it earlier in the year and then obviously more recently with the 10th of October flash crash in digital asset prices. That's not a positive, and it's mostly not a positive because at the end of the day, Bitcoin and other digital assets are a technological solution. So if the NASDAQ will go down sharply, so let's say bad stuff happens on US-China trade or Middle Eastern tensions, for example, then normally Bitcoin and other digital assets go down too. So in those bad days, which are not driven by TradFi type issues like banks going bust, like in March 2023, but bad risk days, the reality is in a lot of those days, correlations do go to 1 if risk assets fall. And so today, obviously NASDAQ's off. It's still trading pretty well, to be fair. Risk assets still trade pretty well, considering last night Powell said that a December rate cut is not a given, whereas the market had gone in pricing 90% likelihood. So if we now need to go to 50-50, obviously there's no data because US government is closed. So it's still quite feasible that you won't get a cut in December. And that's obviously a macro shock for markets today. So you have that as a negative. You have US-China trade positive outcome today. was, I guess, mostly expected. And so now you're sort of struggling. So I can probably see Bitcoin heading a little lower. Obviously, we're trading not so well today, down, overnight. We're down to 108 now. Maybe we'll dip back to 105. The one thing that has held has been the 50-week moving average, which is around 102, 103. So I suspect that still holds. But, we might go down towards that on this risk-off move if it continues for the next few sessions, perhaps through the weekend.
Understood. I think it's really interesting. You point out this fact that a lot of people continue to struggle with this dichotomy with Bitcoin, where it kind of acts like a frontier risk asset in one way, but in the other way, it's perceived as others as digital gold, limited supply. Is that a maturity thing? And what would it take for it to, kind of move past that technology risk asset and into a true digital gold type commodity when it vis-a-vis like macro events? It
has been improving in the last couple of years. So I think since the ETFs launched in the US, best part of 2 years ago, you are starting to gradually change the mix. So crypto, quite uniquely by an asset class, is something like 80% retail, 20% institutional today, and all other asset classes the other way around. So over time, you'll probably see digital assets move in the same direction as others. So that 80-20 will flip. And then you tend to see less sharp down days. And we have seen more of that. Like, it has been moving that direction. So yes, I suspect maturity is one answer. The other for me, though, is I'm not that bothered. Like, if Bitcoin is a hedge against TradFi issues or Trump talking about Fed independence type issues, but it also trades as like a Mag 7 stock, in some ways that's okay. You can kind of have your cake and eat it too. I did a note earlier in the year where I looked at, if you took out one of the Mag 7 stocks and put Bitcoin in, for each of the preceding 7 years, in every year, you would have had higher returns and lower vol. So like in a Sharpe ratio sense, it's a no-brainer to do that. So you can, it's the best of tech, plus it has this hedge against TradFi issues. So actually for me today, I think that's fine. And over time, you're right, probably matures into the digital gold narrative more formally.
Yeah, and you've been very critical of the 4-year cycle. A lot of people, I was at a conference this week and I was talking to a guy, he's like, I just don't know if the time is now to enter the space, the 4-year cycle. You've mentioned some of these institutional buying vectors now, whether it's the ETFs, pension funds, 401ks, or even the digital asset treasury companies. Is the 4-year cycle dead?
I think it is dead. We just need proof that it's dead. So it was very unfortunate that we had the current all-time high was October 6th. And then that, which is the Monday, and that week on the Friday, Trump's tweet late on saw Bitcoin fall, and so we paired quite a way back from the all-time high. And coincidentally, in previous cycles, the amount of months post-halving was about 18 months when you had the cycle high, and the halving was in April 2024. So 18 months would be October. So in my mind, it's coincidental that current all-time high was a very similar number of days or months post the halving as we have this time. So we'll now need proof, if you like. I think the proof will come. It'll come before year end, and it'll come on the back of ETF inflows, which we're now roughly $60 billion of net inflows since the start of 2024. That's the best ETF launch of any asset class in the history of ETFs, right? The previous best ever was QQQ, which everyone knows for NASDAQ, had $8 billion in its first year. And we've had $60 billion in just under 2 years. So it's a massive inflow. And the types of buyers that are buying the ETFs, like the pension funds that you mentioned, like teachers funds, the police, the firefighters, all those super long-term pension fund style, they take a long time to get involved in a new asset class mostly. And so the asset managers that issue the ETFs like BlackRock go around every quarter and talk to all these funds and say, you know what, you should get involved. But it typically takes 8, 10, 12, 14 quarters for them to get involved, and we're only 7 quarters in. So I think, like, in the same way it happened with the gold ETF in the US, which started November 2004, took about 8 years for that market to reach maturity. We're only a couple of years into at least 4 or 5 years, because this is probably a bit quicker. So I'd say we're not even halfway yet.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com.
I totally agree. It takes a long time for the institutions to get their act together, just from a governance perspective and an infrastructure perspective. I think things like the DATs or the ETFs make it a lot easier for them because it's a known regulation. They have the operations all set up, but they still have to set up, in certain cases, and change their investment mandates. But Geoff, you had called 200K for Bitcoin earlier this year as we approached year end. Are you standing by that? Do you think it needs to be adjusted? How do you see the rest of the year plays out for Bitcoin?
To be fair, when we got to 126,000 three and a half weeks ago, something like that, 200K was looking within reach for me. By the end of this year, I felt like we get a couple more Fed cuts.
Yeah.
This Trump-driven US-China spat, which obviously has gone away now, but it's impacted sentiment, I think has made reaching 200K pretty tricky now. But I think we will go higher into year end again, and we will print fresh all-time highs into the year. I guess my stronger conviction now is my medium-term view, which is that by the end of 2028, so by the time Trump leaves office, we'll get to 500,000 Bitcoin. And that for me it's really just a flow story. It's the ETF inflows. And then if you compare Bitcoin and gold in a two asset portfolio mix at the start of this year, so this is where my 200K number came from. At the start of this year, if you look historically at returns and correlations and volatility, you should have been roughly 80% gold, 20% Bitcoin in portfolios globally. But the reality of the market cap is about 90-10. So I thought, well, actually, that should mean instead of 100K, you get to 200K. And that's just on historical volatility. And since then, vol of Bitcoin has collapsed this year. So actually, like in a portfolio sense, global investors are even more underweight Bitcoin than they were at the start of the year when you vol adjust. So over time, I think portfolios do normalize to where they should go. It just takes some time. And the theory here is that before the ETFs started last year, investor access was limited globally, especially, and in the US quite dramatically. And over time, that improves. So therefore, over time, portfolios should go towards where that optimal mix says they should be. And by 2028, even if vol stays where it is now, you can make a case, particularly given what gold has done this year, that you can get to 500K. So that's my very strong conviction. End of this year has perhaps got a bit messy now because of all this China-US trade stuff.
Wow, 500K by 2028 sounds like that's a place where people should be. You've made some other bold calls around 2028. You've talked about $2 trillion in stablecoins and $2 trillion in tokenized products, a mixture of money market funds, equities, et cetera. Let's start with stablecoins. And I think, very recently you published a piece on DeFi. What does this influx of stablecoins mean for the U.S. economy and mean for crypto?
So stablecoins, for those that aren't familiar, are just a digital version of money which is pegged to the US dollar. So obviously people in the US may not think about this, but if you tried to send money from a bank account in the States to, I'm going to make up a country, Uzbekistan, it's probably going to take 2 weeks to get there, like in your normal payments rails. And that's not JP Morgan's fault where your bank account is, but it's, the payments rails are set up in the 80s and 90s. So it's very, very outdated. And stablecoins now have solved that. So instead of it taking 2 weeks and maybe never arriving, you can do payments 24/7, near instantaneous, near a zero cost to any country in the world for the first time. So basically you have an internet version of money in the same way we've had an internet version of information for 2 or 3 decades now, right? So that's a huge positive. Now, to get to large numbers of total stable coins, I looked at where the users are and the users and users. And it turns out today, of the $300 billion of stablecoins roughly in total market cap, about 2/3 of that is emerging market savings use. So this is money that in previous cycles would have left mainland China and other to buy property in London, for example, right? So money's trying to get out of politically or economically challenged locations and put itself into the safest, most liquid, trustworthy form. And 2025, that's stablecoins. It's not, Mayfair property in London, right? So that's where the money's been coming from. So my theory is that over time that continues. So far, it's mostly the super wealthy. Yeah, so it's very large wallets. So this is savings out of EM for oligarch types, right? So over time, they probably tell their friends, they tell their golf buddies. And so you get the super wealthy and the next level wealthy will do this same thing over time because it's super safe, right? Like all stable coins are backed by T-bills, which I'll come to in a sec. Then over time in other countries, you'll have a large amount of less wealthy individuals. So think about Brazilian taxi drivers, for example, that want to get money out of local currency and local country because of inflation or political risk or other, right? And so you stack the two together, and over time, they add up to more than $1 trillion for me in emerging market savings style. The good thing for Scott Besson in Treasury is this is all new T-bill demand because you have to have 100% T-bill backing, and this is all coming from other locations. Yeah? So more than $1 trillion, which is a big new Treasury buyer. So that's, I guess, impact number one is that this US administration has found a new massive buyer of Treasury debt, and it's all in super front end. That has a couple of implications because it's super front end. When it becomes large enough, which for me is probably in 12 months from now, the Treasury can issue more front end T-bills and less debt out the curve. And so that will then change demand supply dynamics out the curve to have yields lower in the back end, which will impact mortgage rates in the US, probably just in time for the midterms in November 2026. And that would start changing the shape of the US yield curve to be flatter. Probably it then becomes dollar positive as well, because you see large inflows to buy assets from emerging markets and other. And so you start to get dollar buying as well. So over time, it changes US interest rates, it changes dollar direction as much as it perhaps weakens emerging markets where flows are coming from. So there's an emerging market negative. And it also extends dollar hegemony, which is one of the things Scott Besson gets as well, right? So over time, for me, this extends dollar hegemony probably by another generation because you're taking what was traditional payments rails in FX and banks, mostly in dollars, but like 2/3 dollars, to now this market's going to be more than 90% medium term in dollars. Currently, it's 98%. So I think that's the very large medium term story on the back of it. It will also then start to impact those who use the stable coins in developed markets like the US, right? So the amount of conversations I've had with Midwest treasurers in the last couple of months, like in the lead up to Genius Act in July and post that. So these are manufacturing types, they're commodity types, they're distribution network style. So corporates that are sort of Fortune 500 style do stuff globally, have operations in lots of countries globally. They're now asking me, they're saying, Geoff, what are stable coins? We've heard of them. How can we use them? This is going to increase capital efficiency for us. So if I go back to my Uzbekistan example before, where it takes 2 weeks to get money from your New York Chase account to Uzbekistan, if you have, as a corporate, operations in lots of those countries, today you need to have cash stockpiles in each country because you don't know how long it takes for money to arrive, right? But tomorrow, because stablecoins are like the amount of time it takes is certain and it's near instantaneous, you can reduce stockpiles so you can become more capital efficient. So if you put your equity sectoral hat on, those types of companies will outperform because they can get same revenue with a smaller capital base, right? So that's a massive positive for those types of companies. Others, like banks, quite frankly, are probably the losers because a lot of this stuff in payments rails and FX markets and other have traditionally been done by banks that have had moats, right? So banking, it's probably a negative. Large sector manufacturing distribution style corporates that are mostly in Atlanta, Chicago, Texas, probably do quite well.
Yeah, that's an amazing response. I think I saw Tether yesterday announced they're sitting on $135 billion of treasuries. And I think you're right. The U.S. government loves when we have new buyers of treasuries. They're actually the 17th largest holder of U.S. debt. They just outpaced South Korea, and they're about to pass Brazil. And that's just one stablecoin company. I've seen a lot of people. I would like to drill into a little bit of this issue around interest. So stablecoins don't pay interest. And one thing that we're seeing in the developing world is that, the dollar, even a dollar that doesn't generate interest, will logically outperform in many cases an inflationary local currency. But there's also ways to get that interest back. And I think we share the opinion that these folks in the developing world are going to use DeFi. They can. It's like right there on their mobile phone. They can go borrow, lend. They can generate interest. How do you think about this as a catalyst for DeFi? And I would think this is going to be very net beneficial for many of the borrow lend protocols, et cetera. So how do you think about that whole interest conundrum?
100%. So where we are today, so you're right, for stablecoins, you can get yield in a couple of ways. Either in the US, if you hold USDC, you could park it in Coinbase, they'll pay some yield. In emerging markets for savings use case, it's probably mostly in DeFi, right? So you take your stablecoin, you park it in Aave, and you earn 4 or 5% yield. It's pretty easy to do. People do it once and they see it's super easy. So this creates users of DeFi. So there's stablecoins to me are doing a number of things now to accelerate DeFi. Your point here is a good one, is it's creating users, which is fabulous, because this is an asset class that it's sort of like you don't learn how to ride a bike by looking at the bike, right? So once you use it, you'll see it's easy to do. The second is that stablecoins now in developed markets have created a lot more knowledge or visibility of DeFi, right? Because stablecoin summer, circle listing, etc., right? So most people in DM now have heard of stablecoins, which is good. The third is liquidity. So a lot of, or most DeFi protocols need a lot of liquidity, particularly around times when traditional markets are closed, like weekends. And now that there's stablecoin liquidity on chain, that's great, because then you can do things on weekends, like close out your tokenized Apple stock on a Saturday night if you're sitting at home watching a game on TV and you want to do that as well. And the next one is stablecoins this year have started to explode lending and borrowing on protocols like Aave and its competitor Compound. So today, roughly $1.5 to $2 billion every day of stablecoin borrowing takes place, new borrowing. And that's a massive acceleration this year. So if you take a step back, you've got liquidity, you've got borrowing and lending, so basic banking functions. You've got knowledge and you've got users, all because of stablecoins. And this now, for me, sets up the next huge influx in DeFi. So if I take the corporate user in stablecoins as my base example here, today, if I make up a corporate, like today they've got $1 million off-chain. Yeah, they've probably parked 90% of that in an off-chain money market fund to get some yield, 10% in cash so they can use it when they need it. Now that they would like to use stablecoins because they've got operations in, Uzbekistan and other countries like that, they want to get on-chain for stablecoins. They'll take their off-chain money market fund, park it on-chain. And so over time, I think you get a lot of migration into products like tokenized money market funds as a result of that. And if you think about the scale of that market off-chain, currently that money market fund space in the US is $7.5 trillion. Yeah. In my mind, you could get about 10% of payments and spot FX go on-chain in the next few years. So that probably requires 10% of that money market fund to be on-chain too, which is 750 billion, which is a massive number.
Massive number.
Today, tokenized real-world assets on-chain are 35 billion. And I think in 3 years, you have 750 in tokenized money market funds. Then you think of other asset classes, right? So assuming we get some clarity either from Clarity Act or from SEC guidelines, at some stage in 2026, US investors will be able to do the tokenized equity thing that started in Europe with Robinhood and with Ondo in other places as well, right? And then you'll also be able to take those assets and put them in DeFi in Aave or trade them on Uniswap. So you'll unlock that too. And then the US listed equity market is $62 trillion today.
Yep.
Maybe it's gone down because of the Fed last night, but that's roughly the number. You need only a small percentage of that to again get, in my mind, about another $750 billion on chain. Like it seems quite easy because you can unlock the DeFi part. Then you're already at $1.5 trillion. Then you get some funds go on chain. So, like someone like a BlackRock says, we've got this off-chain fund, we're going to put it on chain. Then others follow suit. You get illiquid commodities and other. And so you stack up, in my mind, a couple of $1 trillion again by the end of 2028 in tokenized real-world assets on chain too. And this has all been fed into DeFi and others. So it unlocks those DeFi protocols for the first time really to mainstream, which up until this point have mostly been about crypto trading with itself, lending with itself, etc. Now you're getting this real world, like Uber replacing taxi style things going to happen. And DeFi protocols, Aave and others like those, are going to have massive outperformance on the back of it.
Geoff, you make some really bold predictions. I think you're being conservative here on the tokenized equities, and I'll tell you why. We have, we're in the investment management space, and we have to act as fiduciaries for our clients. If you look at a regular fiat equity, or sometimes maybe that's wrong, a normal equity, a traditional equity versus a tokenized equity, once there's sufficient liquidity in the tokenized equity, I'm actually compelled to use that as a product. And the reason why is I can't risk manage it if there's an event on the weekend, positive or negative. I'm going to need those stable coins to fund that equity. So, there's going to be a certain point where the $62 trillion fully has to tokenize because, again, 24-hour markets are better markets if you're risk managing them than not. So how do you react to that?
I 100% agree, and I'm very pleased to be called being conservative, Chris. When,
doesn't happen too often.
No. When I've said that a market that's $35 billion is going to be $2 trillion in 3 years from now. So, no, I mean, all jokes aside, I think you're right. I think once it becomes large enough, it becomes truly self-fulfilling. So, in my mind today, we've just started the self-fulfilling cycle. So we're we've done this, and you're right. Eventually, we're going to do this. So we're just becoming self-sustaining, and then you're right. It gradually takes over everything.
So speaking of bold calls, I think you called 25K for Ethereum by the end of 28. You're talking about all this movement of stable coins, real world assets on chain. Is Ethereum going to be the beneficiary? I mean, we're also seeing a number of essentially stablecoin chains coming out, whether it's Tempo, which is a Stripe layer one. We have Plasma, which looks to be like one of the Tether layer ones, Arc with Circle. Which chains are going to benefit, and how is that going to impact them?
Yeah, I think I think in the first round, if you like, which is all investors care about. So the next couple of years, when we go from 35 billion in tokenized real world assets to a big number, it's going to almost all happen on Ethereum. So the model I'm thinking about there is if listeners have a look at what happened with BlackRock's BUIDL, it was 100% Ethereum, and then over time they've gone bits and pieces on other chains, right? So, but the vast majority is still on ETH. And the reason for that really is just because a lot of this is coming from TradFi. So when I work in a bank that's conservative, banks are run by compliance and risk functions since 2008. If someone in the bank wanted to put forward a proposal to build something on chain, if they said, let's do it on Ethereum, which has been around 10 years and never gone down, no one's losing their job over that, right? So the fact that other chains are faster and cheaper for TradFi is completely irrelevant. I use another analogy, which is, and hopefully some of your listeners are old enough to get this, the payments rails in TradFi today are kind of like Betamax, right? And even though Ethereum is sort of like Blu-ray DVDs, it's not streaming Netflix style videos, right? You've gone from Betamax to DVDs in a heartbeat. It's a huge upgrade. right? So, and all of the senior people in banks know what DVDs are, right? So in this analogy, and so TradFi is going to go almost 100% for Ethereum for the next couple of years. Now, later on, maybe you'll get, some of the faster chains, Solana in particular, could get some of the fast-moving stuff. I think that makes sense. Tokenized equities, perhaps. But for the next couple of years, I think it's ETH. And I suspect my target of 25K ETH 2028 will be too low.
Wow, too low. You're starting to sound like Tom Lee.
Well, exactly. He's, actually, he's obviously helping it get there this year, right? The amount of buying that Tom has done is phenomenal in terms of percentage of ETH bought, right? And they'll be getting close to 5% target by Christmas, which is quite remarkable.
Yeah, I know you're not an equity analyst, but Tom has one of the leading DATs, digital asset treasury companies that we're seeing as structural buyers of crypto. I mean, have they been a game changer? How do the DATs play all into this? And I know you've published some pieces on it. I
think it's a massive game changer. So there's a few pieces for me. So the first is just the pace of buying. So, all your listeners will have heard of MicroStrategy, Michael Saylor. The fastest pace that MicroStrategy got to, and I know Bitcoin's a much bigger asset, but in terms of percentage of the pace that Bitmine is going at under Tom Lee over these 6 months is 2 to 3x the fastest ever months that MicroStrategy did, right? So you're going from 0 to 5% roughly over a 6-month window, which is unbelievable to think about comparing to what MicroStrategy has done for Bitcoin. It's a 3%-ish now, again, in the larger assets. So the buying pace is one. In and of itself, that's enough to become somewhat self-sustaining. And for me, it makes more sense, actually, in Ethereum than it does in Bitcoin. So the original rationale for Michael Saylor was restricted access for investors, right? Before the ETFs, it's difficult unless you know what you're doing to get access to Bitcoin. So the proxy made a lot of sense. And actually today, the proxy still makes sense in a lot of countries. Like I'm in the UK, I can buy MicroStrategy a lot more easily than I can get access to the underlying. So it makes some sense from that perspective. But in Ethereum's case, you get the staking yield in the digital asset treasury company, which you do not in the ETF. I'll go back a step just to explain that. So in proof of stake, you have what's called a staking yield. So instead of mining by computers and you're getting the miners getting paid, those that own Ethereum put that into the system and get paid roughly 3%, which your Caesar tracks, Chris, very nicely, right? So about 3%-ish. Now, if you hold the ETF, so BlackRock's ETHA, the most liquid Ethereum ETF in the US, you get zero staking yield. And that's because the SEC is afraid of unstaking liquidity risk type issues. So you can't have staking yield. In Canada, you get half of it. US might go to half of it as well. But the DATs can capture 100% of that. So the amount of Ethereum that Tom Lee owns now with Bitmine, he's earning staking yield all the time, right? So over time, that becomes a significant reason to own the DATs. And Tom Lee argues that should add about 0.6 to the MNAV, which we could debate. But I think it's not a bad estimate. So the MNAV, for those that aren't familiar, is the value of the company market cap divide value of assets held. Bitmine, I haven't checked today, but it's like 1.3, 1.4, something like that. MicroStrategy is about 1.2 today. MicroStrategy got up to about 3 last year when Trump won the election, kind of got a bit overheated. It should be, in my mind, they should be like 1.2, 1.3, 1.4. Maybe Bitmine should be 1.6, 1.7 if you listen to Tom Lee's plus 0.6. But definitely above 1, I guess, is the point. And so long as you're sustainably above 1, you can keep buying the underlying and turning $1 into $1.50, if you like.
Yeah. Just a disclaimer, Geoff mentioned Caesar as a composite ether staking rate. It's a rate that I co-invented, essentially the risk-free rate of Ethereum. And one of the things I like about Ethereum as well, Geoff, is that it's a nice real yield, right? So it's not a very inflationary yield, which should also play into that MNAV game, which makes things really, really exciting. So there's so much momentum. The markets are like near-term choppy. What are you on the lookout as far as risks go? Like what would, what keeps you awake at night that would derail like these incredible projections?
So the main risk really, which I guess we're seeing a bit of, is macro risk today.
Yeah.
So that's like that. Let's say that's between now and Christmas, that's macro risk. So this is, Trump's 10-10 tweet about China tariffs 100%. Is the Fed going to not cut in December? So that sort of stuff. That's typical things people look at when they're looking at their, NASDAQ type exposure. So that's the in-your-face risk today. The crypto native risk is actually these days relatively low. So it would be handy if we got some regulation or SEC guidelines. Now, there's always political risk around those. The fact the US government is closed obviously has pushed back Clarity Act, which is, given we're trying to get all of this done ahead of the midterms in 12 months from now, if you push that back too far, that's problematic. So that's one, let's say, marginally native risk, which is related to regulation. The SEC guidelines might overcome that, though, so you might be okay even with that. You could have some bad headline risks. Thankfully, in crypto, we haven't really had for a number of years now. Always possible. That we sort of, if you get sharp moves like you saw on 10-10, I actually thought that might unveil some negative things like we saw in 2022 when you had sharp moves. Actually, crypto has held up pretty well since then. Like, a lot of the altcoins had sharp moves lower. A lot of the protocols, though, like Aave, I spoke with Stanny after that at Aave, and they did exceptionally well that weekend. So actually let's say the crypto rails are really holding up this time, which is pretty encouraging. But there is always the risk that, if you have dramatic altcoin down days, you could unveil something that is now kind of like a Walking Dead fund. I guess it's possible. So you could get that. And then, that's probably the main things keeping me awake at night. The other stuff I think is mostly in train now. You're kind of getting into the self-fulfilling motion, and we still have enough runway ahead of any political issues like that could come after midterms, I guess, in the US next year.
Yeah, I'm a little bit less concerned about the clarity, or I think they call it in the Senate, the RFIA Act. I think it's going to be exceptionally difficult to pass. But the one thing that I'm encouraged, you mentioned the SEC. We now have an appointee for the CFTC, who's again Mike Seelig, who many of us know, incredibly pro crypto, Bitcoin, Ethereum, everything else. And one of his criticisms as he's going into confirmation is that he's too close to the SEC, which is crazy because he should be close to the SEC. We want these guys to coordinate. So it feels to me like we're going to enter into this golden age of coordination. And I'll give you an example. One area that I think is holding back our markets are a lack of comprehensive futures. So if you're an institution, it's very difficult for you to go long a DAT, ETF, or anything else because you can't hedge it and you can't take that type of volatility for many institutions. And so I'll give you an example that I'm looking out for, and that's to see, comprehensive futures for the alts, because then people will be able to trade basis, as they leg in. And I think that will be helpful for some of the extreme volatility. Like that's one of the macro things I'm looking for. And I think that can come about just through coordination. Gary Gensler wanted to make everything a security. Chairman Atkins has said, well, wait a second, most of these things are not. So I'm hoping that solves some of our issues. What do you think about that?
I think you're right as well. You never want to sit here and say everything looks good, but it kind of does, right? So, how many meetings I've gone into and I was just like, everything's fine. But obviously it's, you have to have some stuff on the other side sometimes, but it kind of does, like regulation, political backdrop, the flywheel, it's going like it's only macro risk and some of that silliness, but presumably once we get closer to Powell leaving the Fed, even the macro risk goes away because, by definition, there's going to be some politicization of the process. The next guy's going to be more dovish than Powell. Like it's fairly obvious it's going to be the outcome. And so the logic behind things like Bitcoin and then that will lift all boats becomes even stronger. So it's really one of those ones you really want to be buying dips through this window of time, I think. And once you get into 2026, things become clearer on that macro risk point, and then you kind of off to the races, I think.
Yeah, to your point, I was invited down to the Fed Payments Innovation Conference last week, and I sat next to Governor Waller over lunch, and like, I'm not going to kid you, he's as bullish as you are.
Yeah, he's super.
Particularly around stablecoins, and he told me, I saw stablecoins 4 years ago. No one would listen to me. I'm here to disrupt. I'm here to innovate. So it seems like this entire government is focused on innovating and just growing the GDP. So I think you're right. Once we have a successor to Powell, I can't see a situation where they're not incredibly pro crypto, and also, you're right. A lot of the macro challenges come off the table.
I think that's right as well. We just need to navigate probably through the next couple of months.
Yeah.
Get through the December Fed either way, and then 2026 looks pretty exciting, I think.
I love it. Wow, I've really appreciated your thoughts, Geoff. What else are you focusing on that I haven't asked you?
Let's see, what else have we got? So I suppose we should talk a bit about the DeFi winners and where that's going to go, a little bit more detail. So this was a note I literally put out today on the $2 trillion real-world asset market cap idea. I think DeFi is going to be super disruptive. So it creates winners and losers, quite a few losers in TradFi, I suspect. You'll get those that get ahead of it, which hopefully our bank Standard Chartered is trying to get ahead. So you'll have some winners and losers in that space. You'll then have, if you fast forward to AI agents as well, which will be 2026, I can well imagine a broader disruption being unveiled here, which is when there's enough liquidity on chain, plus we have AI agents, individuals like ours or corporates can become extremely capital efficient. So, every time I get paid today, if I want to do investments, mostly I need to be proactive. But my AI agent can do that for me next year. And I can start getting intraday yield on tokenized money market funds with BlackRock, right? So that sort of stuff is just going to be unleashed. And so I think for the first time, it creates interest in the DeFi protocols. Now, mostly interest been in Bitcoin and the layer ones in digital asset investment for the past number of years, right? But I think this, for the first time, lets value trickle down to the protocols. So I particularly like Aave on the back of that trickle down effect. Like if you're going to 50x the amount of real world assets on chain to make up a number, well, actually my prediction is almost 50x, then, that's all going to go into on-chain lending protocols like Aave, right? So it becomes a multiple of. And so I think that's where people now need to go in 2026. So rather than thinking about, in the previous cycle, we had an altcoin cycle. This time it's an altcoin pick the winners cycle, I'd say, right? So Bitcoin still do well. ETH does fine, given it gets most of this DeFi story. But then you go down the market cap table to, numbers 10 to 20, and you start looking in there and you find Aave, you find Uniswap, if they can pass through profits, etc. So I think investors need to kind of differentiate a little bit more this time rather than all boats rising. And it's probably the largest protocols that do well.
Yeah, fundamentals matter. I mean, those are some great protocols you're talking about. You touched on AI agents, which I think are going to be a massive theme. And what people don't realize is that the foundation, the infra is being set. Recently, we saw a protocol release something called X402 that allows micro payments between agents, which I think is going to be another really, really interesting piece. We've also talked in the past about things like Sam Altman's WorldCoin that's going to help people navigate that. How do you see this agentic economy playing out in the crypto space? The
interesting thing, my cynical crypto hat is always to say that once AI does something that's useful, they're going to need a bank account, and that's crypto. So, which I think is where stablecoins come in, right? So, but obviously there are crossovers, and you mentioned WorldCoin. I think what they're doing there around proof of human is super interesting. We're going to circle to at some stage needing zero knowledge proof of individuals or zero knowledge proof of corporates. And this is kind of the first part of that, or the first half of that, if you like. the proof of human or humanity. And so I suspect you'll have a couple of winners in that space, and that will again unlock the next piece here, which is once you have proof of individual in zero knowledge space, then individuals and corporates become whitelisted, and you then step across any KYC AML problems that have otherwise hurt the industry so far, right? So, and then once that accelerates, again, DeFi is the big winner. So I think we're very close to that.
I love it, Geoff. Really appreciate your thoughts today. Any final thoughts before we end the pod?
I think that's it for me today, Chris, and thanks for having me. And I guess I'll just say to investors out there, like, averaging in is always a good strategy when you get volatile markets like we have today, right? So if we're going to be at 500K Bitcoin end of 2028, 3 years from now, keep buying those dips and keep listening in.
Buy the dip, everyone. Amen. Thank you, Geoff. Really, really appreciated your comments today. I love what you're doing, and keep up the good work, sir.
Fabulous. Thanks, Chris.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next. Thank you all for watching. We'll see you again next time.